We're going to start today's session with a conversation with Paroon Chadha, co-founder and CEO of Passageways. Paroon, welcome to the show.
Thank you. Appreciate it. Pleasure being here.
So, Paroon, let's introduce our audience to you. You've bootstrapped a successful company from Indiana, and we love to hear stories and showcase and highlight stories of entrepreneurs who are doing their entrepreneurial work in off-center geographies. So it's a great case study that I wanted to highlight for our audience. So tell us a little bit about Passageways. What do you do, and how did you get started?
Absolutely. So yeah, this goes back to 2003, and this is a company that I co-founded with Christopher Beltran right after school. Both of us were at Purdue, and we really were just trying to figure out if we can, start down the path of creating a platform for collaboration. And, I was going through the MBA program, and there was a business plan competition on campus called Burton D. Morgan. And, as you get more serious about your business plan, we decided to pitch at that business plan competition. And we placed second, we won some money, and that's how we really started to get more serious about it. And when we graduated, we started with Passageways as our, jobs at that time, and then, led on to become a career, and now, it's certainly, it's become a calling at this point, you could say.
So, Paroon, could you talk about, you said collaboration software, so let's double-click down on that topic and tell us what you saw when you started the company and decided to do a collaboration software company. What was the landscape, and where did you find the gap, and what did you decide was the opportunity, and how did you flesh it out?
Absolutely. So, I'll take you back to 2003. This was when Yahoo was a big, provider tech company at that time, much like, what you would say Facebook or, even Uber and some of these newer companies that we all talk about today. Yahoo and eBay actually really were the two big companies. We saw that, collaboration, was happening in the consumer world, loosely speaking, started to show as portals or views that people needed to aggregate all the information, that you may be interested in. And, that led to us thinking about, could we apply the same concept within the enterprise? And we were very early, and I must say, in terms of just starting to think about it. Prior to that, there was a notion of an intranet which keeps everybody on the same page within an enterprise. What we did was we started to really get more serious about, not just piecing together information, but also actually enabling secure collaboration within the enterprise. And, it started out with, some file sharing, some messages, some backend for instant messaging and all of that, and led on to several iterations, and we continue to actually really, work through that as, the secure collaboration space is evolving.
And how did you validate? Who were your early customers? How did you get this in the hands of validated users?
Absolutely. So I think that's a fascinating story, and I think that may be one of the unique things about us. We were on college campus, went through the regular channel, well-established channel of a business plan competition, but somewhere along the way, my finance professor, Professor Sullivan, she asked us to go talk to the local credit union, and their name is Purdue Federal Credit Union. And I had no sense of what credit unions are all about, and I went and I pitched. Actually, this was just a phone call I made from the college campus. At that time, I didn't even have access to a cell phone, and I guess they were intrigued enough to call us over, and me and Chris, we went and we met with the credit union. And when they looked at the software, in a quick 3 meetings, we found ourselves in the boardroom where the credit union not only wanted to actually really buy the software that we were creating, and mind you, at that time the software was pretty, unfinished, but they also wanted to invest in the company because they wanted to make sure that, we are around. And it went very well with what they're all about, making a difference in the community. So this was a unique experience where it went from a finance professor pointing me to a local, credit union, which is nothing but a community, financial services provider. And then, in the boardroom, there was an interesting, thing that happened. The chairman of the board at that time, of course, the board had a lot of people from Purdue, and I believe Professor Sullivan was actually really the chairman of the board. So she wanted to see if we could actually really find traction within the credit union, and if we actually ended up rising, she'd already looked at the business plan. So we had a pretty smooth board meeting, I would say, but that is how it all came together.
And was there specific functionality requirements of the credit unions that you were able to address?
Absolutely. So they had a budget in mind. So this was a budgeted item. They just couldn't find the right solution. They wanted to make sure that they don't go around, the regular beaten path of let's invest some money in, say, SharePoint or something like that. SharePoint had just started to show up from Microsoft at that time. So they invested $30,000 in the solution. They gave us $100,000 in seed capital. And their only requirement was that we want to create an environment which is role-based. Essentially, when a teller logs in, he or she should be able to get to all the information that makes them very functional. And if they want to collaborate with the back office, let's say the branch manager or somebody back in the corporate, they should be able to do that without leaving the screen in front of them. If you think about a retail environment in a bank or a credit union, and by the way, we have about 700 banks and credit unions as customer today. So we've stuck to that niche. That niche has been a big part of our, ongoing success. The fact is that you can't leave the face of the customer when you're talking to somebody. It's not cool for a teller to turn around, go find help. So one of the interesting things that we, did up front was we actually just shadowed a lot of, tellers and, saw how that interaction with the customer actually really happens. And typically, they need to pull in some documents. They need to, talk through some products and, reference some procedures. But every now and then, there could be like a fraud that they may suspect, and they need to contact somebody in the risk department without really kind of just, making it obvious. And those were the interactions that they wanted us to attempt as a second phase. The first, get everybody on the same page in a role-based environment. Secondly, start to work through the workflows that are specific to their environment. That's why we started out with a portal platform with a core set of functionality, which is all about communication and collaboration, and then subsequently start to build those specific workflows, which are very vertical specific.
And based on that experience, were you already convinced that you were going after the banking and credit union market, retail banking and credit union?
Well, now it's common wisdom that you think big and then you find a niche and really go after that niche. Back in the day, it wasn't this clear. Clearly we've all evolved, when it comes to the process of innovation. But what I found surprising, certainly I didn't grow up, I grew up in India, so I certainly didn't have much of a, knowledge about, how the financial landscape is organized there. There are 6,000 credit unions and about, 6,500 community banks roughly in U.S. alone. That's a big number. So when we started to go after, this market, what we realized is that, years later, we still haven't actually made a significant dent. Now, a lot of these credit unions and community banks are much smaller. So this was a big enough niche for us to actually go after. And that was sort of, how we started out. And we stayed true to that for several first years.
So you did consciously decide to go after this niche, even then?
We did, actually. So for several years, like good, 6-7 years in the journey, if there was a lead that came through a referral or through an employee going from one place to the other, we actually really just actively refused taking that on. We felt that that's going to be a distraction, in part motivated by the fact that we had a rich pipeline of ideas coming from this vertical, and we didn't want to actually really go away from that. Our goal was to dominate the financial services market. We figured that's a pretty big part of the economy. It's about 13, 14% of the economy. And if we can actually really just be very good at that, there will be a time when we can diversify. And as we all know now, in 2009, when the financial crisis happened and that hit us, that was the perfect time for us to start thinking about diversifying outside.
So from 2003 to 2009, you focused on banking and credit unions, community banking and credit unions.
Absolutely. Yep.
And how, revenue-wise, how far did you get with that strategy?
We crossed about, 3.5 million. I think we were right around 3.5.
In 2009.
Yeah, and one of the interesting things about where we were, we took 100,000 in seed capital, but we've been profitable right from year one. We got 10 sales in year one. We had about $300,000 in revenue bookings in year one. And we continued to, and we ended up on the Inc. 500 list. Facebook reminded me this morning that we were on the Inc. 500 list back in 2008. This was literally the day when we celebrated that in our offices. But the fact is, because we were bootstrapped and we were actually really focused on the business model, we are trying to sustain ourselves rather than burn some external capital. We found ourselves to be fiscally very disciplined. And, when it came time to look at, diversification, our first thought at that point was, can we start to prove some diversification, areas, some verticals that actually really jump out before we went out to, take money. But with the Inc. 500, listing, there was plenty of capital available. We just wanted to be sure about, where we are headed and how much money and so on.
And what were your conclusions based on that assessment of what diversification, do you want external financing or not? What conclusions did you come to at that point?
So one of the key things that, I would encourage your audience here to think about is that one should not take money for, nearly as long as you don't need to. Taking money is very expensive. And, even though I know around us there's a culture of celebrating when people raise money, I think there should be a culture more of celebrating when you can avoid taking money. My example is a good one. Up until, literally 2 months ago when we took some capital, we have been bootstrapped. And, I got a chance to buy back both my partners. So, when we got to about, 70, 80 employees and, as we are nearing, some good revenue milestone, 1,000 customers, I was still completely in control, and we never took money. Why? Because the fundamental business plan was, was cooking. We were generating profits, and we just reinvested our profits every year. Now, could I do it differently thinking back at it? I'm sure there's a lot of, coulda, woulda that you can actually get into. But I think on balance, the fact that we continued to be bootstrapped really built an organization that's been very sturdy and continues for every single year in our history. We've grown and we've turned a profit. And I think that's something that's, that you don't find often enough. So, if people in the audience wants to ask me questions about that, and there are several other such companies that I've seen, and I've met founders and owners, we all feel that this is not an easy path, but certainly, a path that, is worth considering seriously for most organizations.
So in 1Mby1M, bootstrapping has always been one of the core tenets because, just by the mission, as you can see, 1Mby1M, 1 million companies are not going to get funded. We acknowledge the fact that over 99% of the entrepreneurs out there do not get funded, and we are committed to supporting entrepreneurs who are bootstrapping. We constantly encourage people to bootstrap. Most businesses out there have to be built as bootstrap businesses. They don't qualify as fundable businesses. They don't have the trajectory of hyper growth. They don't have the super large TAM. So most businesses out there have to be built the way you have built your company. So your point is very well taken and very much in tune with the ethos of this organization. Now, let me ask you a couple of questions here. You haven't answered my diversification question. So at this point, are you still doing banking and credit union, or have you opened up other verticals?
We have opened up at this point. We are, routinely adding maybe 5 to 10 customers. A typical month for us is about, 30 to 40 customers. And we see 5 to 10 customers come from higher ed, another, a few coming from healthcare, about 8 to 10 coming from nonprofit. In fact, recently what we are starting to see is more than 50% of our customers are coming from outside the financial services industry. Not only that, we've also diversified geographically as well.
So this time round, you're not doing a vertical specific expansion. You're basically going after whatever is coming to you.
I think that's a good question. So let me actually get into some more detail on this. So in 2009, we started to look outside the financial industry. When the iPads came around, a lot of our customers were using our enterprise portals for their board meetings as well. So we started to build a cloud-based specific portal for the board meetings. And now we have 2 products. So Ensemble is the enterprise collaboration, and Onboard is the board collaboration software. That board collaboration software, board meeting is board meeting depending on, how you look at it. But, from a system standpoint, public companies are slightly different than, private companies and nonprofits. But, fundamentally, there is a lot of similarity between how board meetings are conducted. So we naturally started to diversify into other verticals. And we also started to, set up resellers in other countries, and now we have an office in UK and Canada as well. We have direct presence in other geographies. So we diversified both on the product itself, so Ensemble and Onboard. We also started to really get into other geographies. And lastly, I would say, as we evolved the software, we went from diversifying out of the on-prem environment into the cloud and mobile environment. Those were the 3 things that happened post-2009.
So in terms of the 2 products, would it be fair to say that your collaboration software is primarily sold to the banking and credit union segment, and the board meeting software is outside of that segment?
I think, that was the case for the longest time. At this point, both our products are actually, vertical agnostic.
Okay. So now bring us to the competitive landscape issue a bit. Of course, there's a lot of collaboration software out there, lots of stuff going on in that sector. How have you navigated the competitive landscape, and where do you sit now, given the level of activity in the industry?
Yep. So, certainly on the enterprise collaboration side, there are several, several different competitors that we run into. SharePoint is still around. Huddle out of UK is actually really a big one that we started to see, regularly, pretty well-funded company. And then we also see some smaller, cloud-based, takes on enterprise collaboration. Again, we've built our software, growing up in the financial services industry. So when it comes to regulations, healthcare and financial and higher ed, these are the industries where we have a very well differentiated product, much more so than any other that we find. So, how you grow up, you start to see the world in that way, and, you really have certain strengths that stay with you, and I think that's, pretty core to how we fit in the enterprise collaboration space. In the board collaboration side, Onboard, our main competitor is Diligent, and they've done a few acquisitions lately, and then NASDAQ. NASDAQ actually acquired a company by the name of Boardvantage. These are the 2 main competitors. I think it's a pretty clear, differentiation. Both these softwares are, the companies are, well established, and But both these offerings are, legacy as you would define today. They're not cloud first or, mobile first kind of setups, and they cater more to the Fortune 500 companies. We came in, wanting to disrupt that, and we found a lot of success in just, working with startups, working with, private companies. Certainly, like I said, the banks and trade unions, are still the mainstay. And at this point, we are well past 1,000 customer mark to really kind of just, put this into perspective. So the landscape is shaking out, on the board side, as there are some enterprise providers and diligent board vantage, and we have our fair share of enterprise customers, but we really are becoming dominant when it comes to the mid-market and the SME space.
Mm-hmm. Now, you mentioned that you've recently taken some funding. Can you take us through the thinking behind at what point you decided to take this funding? What was the revenue level? What were the metrics? And why at that point did you decide to bring in investors? Because you have navigated very well for a long time in an organic bootstrap basis, and you're profitable, you're growing nicely. What is the thinking?
Yeah, that's a good question. So, so I struggled with this one, as you can imagine, because, through these headwinds, I stayed away from taking funding. One of the challenges that we had, and I think this is something to be consciously aware of if you go down the bootstrap path, you have to make sure that the core founding team and the, leadership team, if you have an employee pool, everybody is committed to that path. Sometimes what happens is that different, execs on your team, certainly when it comes to co-founders, they may have a different trajectory in mind. In our case, I had another co-founder with me, Christopher. Until Chris and I were co-piloting this, bootstrapping was the only way to go. Once Chris actually left, I found there were two gaps. One, we really started to first find a lot of growth opportunities. So for the first time in all this while, I found myself really staring at opportunity where, taking money would accelerate us many times over. Okay, so that was one consideration. Number two, I found that, as we got closer and closer to a 10 million run rate mark, the stakes became much higher. I needed more eyes on this ball. Why? Because there is some strategic advice that you get when people, contribute capital, more formal governance structure with a board meeting and such, and that allows you to think strategically about, the long term as well. So these two considerations really got me closer to considering this. And as as the revenue started to climb and the growth rate was, looking very healthy, there's plenty of capital that's available. This is a good time to raise money if you find yourself in that boat. Why? Because the market is actually really flush with a lot of capital being available. Certainly, if you show that you have traction and there's certain repeatability in your business. Once those unknowns are out of the way, you start to see that you start to attract good, investors. You also really, find that that additional $5 million or, $10 million in capital is going to allow you to, grow, in ways that you're just not going to be able to justify, if you continue to bootstrap.
And Paroon, did you have to buy Chris out, or did Chris stay in for the long haul in terms of his share holding pattern?
So Chris was a non-operating, owner for a couple of years, and Purdue Fed has always been non-operating. So over the years, so actually just 2 years ago, I got a chance to really, think through the future, and there were some big bets to be made. Before those were to be made, it came down to a decision of who all are going to be in the cap table. And I, converted some of their equity into loans, but I did actually buy them out, both of them. Purdue Fed also had some, pressure from the regulators because they're not, it's okay to invest in a small startup in the local community, but when you start to sell software in Kenya and Nigeria and UK and Sweden, there's, some risks that, they're not comfortable with anymore. So, both these lined up. And, I'm glad I did that simply because when you simplify your cap table, you really have the capital market opens up significantly as well. So that's another thing to keep in mind as you bootstrap this. If there are early investors and founders, there are some inflection points in your journey where one should think about making offers to really buy back people who have been sitting on the cap table for a long time. And you'll find that they actually really may embrace that opportunity as well.
Yeah, and also there are investors who specialize in this kind of deals. If you get to a certain level of success and repeatability where investors do want to work with you, there are certain funds that specialize in doing these kinds of transactions who would be willing to come in and buy out maybe co-founders, give some liquidity to the founders, buy out early investors, and simplify the cap table and set it up for further capitalization, further growth, and so forth. So there are lots of options that open up if you, what we call this strategy is bootstrap first, raise money later. And there are many different variations of it. You could be doing this early on in your cycle. You could be doing it when you reach 5 million, 10 million in revenue. You could be doing it when you reach 20 million, 30 million in revenue. But the concept of bootstrap first, raise money later is a mantra that we believe in very strongly, and that's why I wanted to invite Paroon here to share his story and his journey with you so that you can learn from what his insights are. So Paroon, thank you very much for